Most traders believe the problem is discipline. They think if they could just control themselves better, follow rules more strictly, or silence their emotions, consistency would finally arrive. But here's the truth few are ready to face. Discipline has never been the real issue. The real issue is that most traders are operating without a model, without structure, and without intentional design. And chaos always wins against improvisation. If you've ever followed your rules and still lost, if you've ever done everything right and felt something was still missing, this conversation is for you. Because trading does not break down at the level of entries or exits. It breaks down at the level of architecture. And until that architecture is built, no amount of effort will save you. This channel exists for traders who are done chasing signals, done reacting to randomness, and done blaming themselves for a system that was never designed to support consistency. This is Trading Rebels, where we dismantle the myths that keep traders stuck and rebuild trading from structure, recurrence, and intentional authorship. In this deep dive, you're going to understand what a trading model really is, why structure matters more than any signal, why randomness is not your enemy but your misunderstanding, how recurrence creates stability through time, and how intentional design turns a reactive trader into an author of their own process. This is not motivation. This is reorientation. If you're serious about evolving beyond chaos, subscribe to the channel now so this way of thinking becomes part of your environment. Like the video to support work that challenges surface-level trading education. Share it with a trader who is still trying harder instead of designing better. And stay with me, because what you're about to hear isn't meant to entertain you. It's meant to reorganize how you think, trade, and operate in the market. Let's begin. What a model is. Most traders don't fail because the market is difficult. They fail because they are trading without a model, even when they believe they have one. This is the uncomfortable truth most trading education avoids, because it exposes how shallow the industry's definition of a strategy really is. A few indicators, a set of entry rules, a stop loss, and a profit target are not a model. They are instructions, and instructions without architecture collapse the moment pressure enters the system. A model is not something you follow. A model is something you inhabit. It is the internal logic that governs your decisions before emotion ever shows up. It is the framework that decides for you when your mind would otherwise hesitate. When traders say, "I know what to do, I just can't do it consistently," what they are really saying is, "I don't have a model strong enough to carry my behavior." Think about chaos for a moment. Chaos is not randomness. Chaos is unstructured complexity. It is what happens when too many variables are present without a governing principle. That is exactly how most traders approach the market. They open charts flooded with information, opinions, signals, timeframes, news, and expectations, and then they expect discipline to magically impose order on that chaos. It never works. Discipline does not create order. Design does. A trading model is the mechanism that converts chaos into coherence. It answers questions before they arise. It reduces decision-making to execution. It removes interpretation where interpretation becomes dangerous. When you have a true model, you are not asking the market what to do next. You are asking whether the market has aligned with what you already designed. This is why so many traders feel exhausted. They are thinking their way through every trade. They are negotiating with themselves in real time. They are improvising under pressure. A model removes improvisation. A model replaces reaction with recognition. You are no longer guessing what the market means. You are recognizing when it fits. Here is where most people misunderstand models. They think a model is restrictive. They believe it limits opportunity. In reality, a model liberates you from noise. It narrows your attention so powerfully that everything irrelevant simply disappears. When traders say, "I want flexibility," what they usually mean is, "I want permission to break my rules when I feel uncomfortable." A real model does not argue with you. It governs you. A model is also not something external. You cannot borrow it fully from another trader. You can learn principles, structures, and logic, but the model itself must be internalized. It must match your cognitive rhythm, your risk tolerance, your decision speed, and your psychological architecture. That is why copying strategies rarely works long term. The structure does not belong to you, so under stress, you abandon it. This is where the shift from chaos to intentional design begins. You stop asking, what strategy should I use? And you start asking, what structure can govern me? You stop searching for better signals and start building better constraints. You stop relying on motivation and start relying on architecture. A model defines what matters and, more importantly, what does not. It decides which markets you ignore, which days you do not trade, which conditions invalidate participation, and which outcomes are irrelevant to your identity as a trader. Without this, every win inflates you and every loss destabilizes you. With a model, outcomes lose emotional authority. They become data, not judgment. This is why traders with models sound calm, even after losses. They are not detached because they don't care. They are detached because the loss did not violate the structure. Chaos feels personal. Structure feels procedural. That difference alone separates amateurs from professionals. A model also creates continuity through time. Without one, every trading day feels like a fresh battle. With one, each session is simply another iteration of the same design. This is where consistency is born. Not from discipline, not from confidence, but from recurrence. The model repeats itself. You simply participate. If this is making you uncomfortable, that's a good sign. It means you are realizing that what you've been calling a system might just be a set of habits held together by hope. Hope is not a component of a model. Design is. Ask yourself this honestly. If emotion disappeared tomorrow, would your trading still function? If the answer is no, you don't have a model yet. You have rules waiting to be broken. A true trading model does not depend on how you feel, how the market feels, or how confident you are that day. It operates whether you are tired, excited, fearful, or bored. It does not need your discipline to survive. It was designed to survive you. This is the foundation. Everything else builds on this. Until you understand what a model truly is, structure will feel optional, randomness will feel normal, and consistency will feel mythical. It isn't. It is engineered. Structure over signal. Most traders are addicted to signals, even when they claim they are not. They may dress it up with sophisticated language, talk about confirmations and confluence, but at its core, they are still hunting for permission from the chart. A green arrow, a crossover, a pattern, a candle shape that whispers now. Signals feel comforting because they appear objective. They look like answers. But signals do not create consistency. Structure does. A signal is a moment. Structure is an environment. That distinction changes everything. Signals operate in isolation. They fire, they disappear, and they demand interpretation. Structure, on the other hand, exists before the signal and survives after it. Structure determines whether a signal even matters. Without structure, a signal is just noise dressed up as opportunity. With structure, the signal becomes irrelevant because the decision was already made. This is where most traders get trapped. They believe better signals will fix their inconsistency, so they keep searching. They add indicators. They change settings. They jump from method to method. What they are really doing is outsourcing responsibility. They want the market to tell them what to do instead of designing a framework that decides in advance. Structure does not ask, is this a good signal? Structure asks, does this belong? Belonging is a higher filter than accuracy. A signal can be accurate and still destructive if it appears outside your structure. This is why traders can be right and still lose money. Accuracy without structure is meaningless. When structure governs your trading, your chart becomes quieter. Not because the market changed, but because your attention did. You are no longer scanning for excitement. You are waiting for alignment. Most candles no longer matter. Most moves no longer tempt you. This is what professionals mean when they say, I don't see what most people see. It's not superior vision. It's superior filtering. Signals demand reaction. Structure enables recognition. Reaction is fast but fragile. Recognition is calm and repeatable. When a trader reacts, they engage emotionally. When a trader recognizes, they execute procedurally. That difference is the difference between chaos and control. Here's a hard truth. If removing one indicator from your chart changes your confidence, your trading was never structured. It was propped up. Structure does not collapse when a tool is removed. Structure remains intact because it is conceptual, not cosmetic. Think of structure like a building's foundation. You don't admire it, you don't talk about it, but everything depends on it. Signals are like furniture. You can rearrange them endlessly, but if the foundation is weak, nothing feels stable. Traders obsess over furniture while ignoring the foundation. Structure defines context. It defines when you are allowed to participate and when you are not. It defines risk before reward. It defines invalidation before entry. Signals do none of these things. They only point. They do not protect. This is why structure reduces emotional load. When structure is clear, you are not negotiating with yourself. You are not wondering if this signal is good enough. The answer was already decided. Either the market is in your environment or it isn't. Either the conditions exist or they don't. Your job is not to decide. Your job is to observe compliance. Signals make traders feel busy. Structure makes traders feel bored. And boredom in trading is a sign of health. It means you are no longer stimulated by randomness. You are no longer entertained by volatility. You are no longer addicted to action. This is also why structure scales while signals do not. A trader with signals needs constant attention. They must watch every candle, every tick, every fluctuation. A trader with structure can step away. The model does not require vigilance. It requires alignment. Ask yourself this. If the signal appears, but your structure is absent, can you ignore it calmly? If the answer is no, then the signal owns you. Structure reverses that relationship. Structure owns the signal. The market does not reward clever entries. It rewards consistent participation in favorable environments. Signals try to predict. Structure prepares. One is fragile. The other is durable. This is the quiet rebellion most traders never make. They stop asking what the market is saying and start enforcing what they will respond to. They stop reacting to information and start operating within design. Once structure becomes primary, signals fade into the background. They are no longer the hero of the story. They are just confirmations that the environment you designed is active. And this is where the trader begins to feel something unfamiliar. Calm authority. Not confidence based on hope, but confidence rooted in design. The kind that doesn't spike after wins or collapse after losses. The kind that remains steady because it is not borrowed from the market. Structure over signal is not a preference, it is a necessity. Without it, you will always be chasing clarity in a system that thrives on ambiguity. With it, ambiguity becomes irrelevant. Death of randomness. Most traders secretly believe the market is random, even when they say they don't. They might talk about probabilities, edges, or expectancy, but deep down, their behavior exposes the belief. They treat wins like luck, losses like betrayal, and every new trade like a fresh roll of the dice. That belief is not harmless. It is the psychological root of inconsistency, because if the market is random, then nothing you do truly matters beyond chance. Randomness feels convenient. It absolves responsibility. It explains failure without demanding structural change. But randomness is not the nature of the market. It is the symptom of an unstructured observer. Chaos looks random only when you lack a framework to recognize order. Here is the uncomfortable truth. The market is not random, but it is indifferent. It does not respond to your opinions, your emotions, or your hopes. It responds to structure, liquidity, behavior, and repetition. What traders call randomness is usually just complexity they have not learned to organize. When you operate without a model, every outcome feels disconnected. One win does not inform the next. One loss feels like an anomaly. There is no continuity. This creates emotional whiplash. You hesitate after losses. You overtrade after wins. You are constantly recalibrating your confidence based on short-term outcomes. This is not because you are weak. It is because randomness has been allowed to dominate your perception. The moment a trader adopts structure, randomness begins to die. Not instantly, not magically, but progressively. Patterns start to repeat. Environments begin to look familiar. Outcomes start clustering instead of scattering. You realize that losses are not surprises. They are expected costs within a larger design. Wins are no longer miracles. They are confirmations. This is where most traders misunderstand probability. Probability is not about predicting the next trade. It is about trusting the repetition of conditions over time. Randomness focuses your attention on individual outcomes. Structure pulls your attention to sequences. One trade means nothing. 10 trades mean something. 50 trades reveal truth. Without structure, you experience the market as a series of disconnected events. With structure, you experience it as a flow. That shift alone changes your emotional relationship with trading. You stop flinching at every loss because the loss no longer violates your expectations. It was already accounted for. This is why traders who complain about randomness are often the same traders who constantly change their approach. They are trying to escape variance instead of mastering it. But variance is not the enemy. Unstructured participation is. Let me be direct here. If you believe the market is random, you will never fully commit to a model. You will always keep one foot out the door. You will override rules. You will hesitate. You will interfere. Randomness justifies interference. Structure forbids it. And this is exactly why so many traders sabotage themselves at the worst possible moments. Right before consistency emerges, they panic. They abandon the model. They change something that didn't need changing. Why? Because randomness trained them to distrust repetition. This is where I want to speak to you directly. If this perspective is shifting how you see your own trading, if you are starting to recognize where randomness has been quietly shaping your decisions, this is your signal to stay connected. Subscribe to Trading Rebels, not for motivation, but for clarity. Share this with another trader who still believes consistency comes from luck. And leave a comment describing the last time you changed a system because you thought the market was being random. That reflection alone will teach you more than another indicator ever could. Now back to the core idea. The death of randomness does not mean every trade wins. It means every trade belongs. Belonging replaces hope. Belonging replaces fear. When a trade fits your structure, you execute calmly. When it doesn't, you ignore it without regret. Randomness loses its grip because you no longer participate everywhere. This is also where traders begin to feel time differently. Days stop feeling urgent. Weeks stop feeling rushed. You are no longer trying to make something happen. You are waiting for something to repeat. That patience is not discipline. It is alignment. The market has memory, not in a mystical sense, but in behavior. Participants repeat. Liquidity behaves in patterns. Reactions cluster around familiar zones. When you have no model, this memory looks invisible. When you have structure, it becomes obvious. Randomness thrives in ignorance. It fades under understanding. And here's the final blow to the myth. If the market were truly random, no one would survive long term. Institutions would not exist. Risk models would fail. Capital would not compound. The very existence of consistent operators disproves randomness. What they have that most traders do not is not superior intelligence. It is superior structure. Once you accept this, responsibility returns to where it belongs. Not as blame, but as power. You stop asking why the market did what it did and start asking whether you participated correctly. That question is answerable. That is where growth lives. The death of randomness is not comforting at first. It removes excuses. It demands ownership. But it also unlocks something far more valuable: control over your process, if not the outcome. And process is the only thing you were ever meant to control. Philosophy of recurrence. Most traders misunderstand repetition. They think repeating something means doing the same thing mechanically, blindly, without thought. So they resist it. They want variety. They want excitement. They want to feel clever. But the market does not reward novelty. It rewards recurrence. And until a trader understands this, consistency will always feel out of reach. Recurrence is not repetition of action. It is repetition of conditions. This distinction is critical. When traders repeat actions without understanding conditions, they become rigid. When traders recognize recurring conditions, they become precise. The first leads to burnout. The second leads to mastery. The philosophy of recurrence begins with a simple realization. Markets do not move forward in straight lines, but they do move in familiar rhythms. Participants change, news changes, narratives change, but behavior clusters. Liquidity seeks similar places. Fear expresses itself in similar ways. Greed reveals itself with familiar urgency. When you lack structure, these rhythms blur together. When you have structure, they become unmistakable. This is why experienced traders often say the market feels the same, not because nothing changes, but because what matters repeats. Recurrence is the market's way of revealing order over time. It is not loud, it is subtle, and it only becomes visible when you stop chasing every moment and start observing sequences. Most traders operate moment to moment. They evaluate themselves trade by trade. This is why emotions swing so violently. One loss feels catastrophic. One win feels validating. Recurrence dissolves this instability. When you think in sequences instead of moments, no single outcome carries emotional weight. Meaning emerges only after repetition. This is also why traders who lack a model constantly ask, "Is this still working?" They are measuring effectiveness too early, without enough recurrence to reveal truth. A model cannot express its edge in isolation. It needs time. It needs repetition. It needs consistency of application. Without recurrence, probability never has a chance to surface. There is a deeper layer to this philosophy. Recurrence is how identity is formed. You are not defined by what you do once. You are defined by what you do repeatedly. Trading is no different. A trader without recurrence has no stable identity. One day confident, the next doubtful. One week aggressive, the next timid. Recurrence stabilizes behavior, and stable behavior produces stable results. This is why the best traders are not emotional minimalists. They are recurrence maximalists. They do not try to eliminate emotion. They reduce decision frequency. They reduce choice. They reduce variability. They allow the same conditions to present themselves again and again, and they respond the same way each time. Over time, emotion loses influence simply because it is no longer invited into the process. If this perspective is resonating, take a moment right here to like this video. Not out of habit, but as a signal to yourself that this way of thinking matters. Liking the video helps this reach traders who are still stuck chasing randomness. And it anchors you to ideas that reward patience instead of impulse. Recurrence also reframes patience. Patience is not waiting endlessly. Patience is waiting selectively. When you understand recurrence, you stop feeling like you are missing out. You know another opportunity is coming because conditions repeat. Urgency dissolves. FOMO weakens. You are no longer afraid to stand aside because standing aside is part of the recurrence. This is where many traders become uncomfortable. They realize that most of their activity was unnecessary. They were trading movement, not structure. They were participating everywhere instead of participating intentionally. Recurrence demands restraint. It asks you to say no far more often than yes. And saying no is psychologically harder than clicking buy or sell. But restraint is where power accumulates. Each ignored setup strengthens trust in the model. Each past trade reinforces identity. Over time, restraint becomes automatic. You are no longer fighting impulses. You are operating within design. Recurrence also solves a problem most traders cannot name: inconsistency of confidence. When confidence is tied to outcomes, it fluctuates wildly. When confidence is tied to recurrence, it stabilizes. You trust the model not because it won today, but because it has expressed itself hundreds of times before. Confidence becomes historical, not emotional. This is why journaling outcomes without context is useless. What matters is whether conditions repeated and whether you responded consistently. A losing trade that followed the model strengthens recurrence. A winning trade that violated it weakens recurrence. Most traders invert this logic and sabotage themselves. The philosophy of recurrence teaches you to respect time. Not clock time, but experiential time. The market reveals itself slowly. Edges mature. Understanding deepens. Trying to compress this process only creates distortion. Traders who rush always feel behind. Traders who respect recurrence always feel grounded. At its core, recurrence is about trust. Not blind trust, but earned trust. Trust built through repetition, observation, and restraint. When recurrence becomes central to your thinking, trading stops feeling like a performance and starts feeling like a practice. And practices, when designed correctly, compound. Intentional authorship. At a certain point in a trader's evolution, a quiet but irreversible shift occurs. The trader stops asking how to win and starts asking who they are becoming through repetition. This is the moment trading ceases to be an activity and becomes an authorship. Not authorship over the market, that illusion dies early, but authorship over self, over behavior, over decision-making, over identity. Most traders never reach this stage because they never stop outsourcing authorship. They let the market author their emotions. They let wins author confidence and losses author doubt. They let opinions, news, other traders, and social media author urgency. Their trading account becomes a diary written by external forces. Intentional authorship is the refusal to let that continue. To author is to decide in advance. It is to declare what you will respond to and what you will ignore. It is to choose structure over stimulation, recurrence over novelty, design over reaction. When a trader becomes an author, they stop waiting for the market to give them permission to act. They already know the terms of engagement. This is where trading finally becomes quiet. Not empty, not passive, but internally settled. The noise does not disappear from the market, it disappears from you. You no longer feel pulled into every move because you are no longer available to everything. Availability becomes selective. Attention becomes disciplined not by force, but by design. Intentional authorship means you are no longer trying to prove anything. Not to yourself, not to the market, not to anyone watching. Performance anxiety fades because performance is no longer the goal. Expression of structure is. Each trade becomes a sentence in a larger narrative. Some sentences are short, some are costly, but all belong. This is where many traders experience an unexpected discomfort. Responsibility becomes total. There's no randomness to hide behind, no system to blame, no rule to accuse. When you author your trading, every deviation is visible. Every impulse is exposed. This level of honesty is rare. It is also where mastery begins. Authorship also changes how you experience losses. A loss no longer asks, "Why did the market do this to me?" It asks, "Did I remain faithful to the design?" That question is grounding. It is answerable. It restores agency. When the answer is yes, peace follows. When the answer is no, learning follows. Either way, growth continues. This is why intentional traders are difficult to shake. They are not emotionally brittle because their identity is not outcome dependent. They do not need the market's approval to feel competent. They already know who they are because they designed it. Authorship also introduces ethics into trading. Not morality imposed from outside, but internal coherence. You begin to feel when a trade violates your design, even if it wins. That discomfort is not weakness. It is integrity. It is the internal signal that your authorship matters more than short-term reward. This is the final separation between chaos and intentional design. Chaos is living inside reaction. Intentional design is living inside authorship. One scatters energy, the other concentrates it. One produces burnout, the other produces longevity. If you are listening to this and feeling both challenged and strangely calm, that is not an accident. That is recognition. You are recognizing a version of trading that does not require you to be faster, smarter, or more disciplined than everyone else. It requires you to be more deliberate. This is the rebel distinction. Rebels are not loud. They are not impulsive. They do not fight the market. They withdraw from its psychological traps and operate from architecture. They do not chase freedom. They build it. And this is where I leave you with a charge, not a suggestion. If this series has shifted how you see your trading, anchor it. Subscribe to Trading Rebels so this way of thinking stays in your environment. Share this with a trader who is exhausted from trying harder instead of designing better. Comment below with the single realization from this video that unsettled you the most. That discomfort is where transformation starts. And understand this clearly. The market does not need you to be perfect. It does not need you to be fearless. It does not need you to be endlessly disciplined. It responds to structure, repetition, and intentional engagement over time. Chaos is not defeated by effort. It is defeated by authorship. You are not here to react forever. You are here to design yourself into consistency. Stand in that. This is Trading Rebels.